Semiconductor stocks just went from their best quarter on record to flirting with a bear market. The Philadelphia Semiconductor Index gained 81% in the second quarter. By mid-July, much of that confidence had disappeared. Wall Street is starting to question whether the AI trade has gone too far. Here's what nobody's telling you. This isn't the AI story falling apart. It's the market asking a much harder question than it was asking 6 months ago. After hundreds of billions in spending, investors want to know when all those AI data centers actually produce even an acceptable return. But inside the semiconductor industry, something very different is happening. Companies are preparing for a manufacturing cycle bigger than anything we've seen this decade. Semi expects global semiconductor equipment sales to reach a record $165.9 billion in 2026, a 23% jump in a single year, climbing toward $229.5 billion by 2028. Share prices are cooling while spending on chip-making tools keeps climbing. That gap could be the next opportunity in the AI supply chain. Unless investors have already priced in too much, Applied Materials, Lam Research, and KLA sit in the middle of that debate. They sell the machines used to deposit materials, etch patterns, and catch defects inside advanced chips. One offers the broadest exposure. One has the greatest memory cycle leverage. One owns the strongest process control moat. I'm Phoebe with TradingKey. Today, we are following the AI money beyond the chip designers and into the factories behind them. We will compare these three companies, examine the orders supporting their growth, and identify the risks that could break the investment case. From buying chips to building fabs. For the past 3 years, the easiest way to invest in AI was to follow the chip designers. Cloud companies bought accelerators as fast as suppliers could ship them. NVIDIA became the face of the boom. AMD fought for accelerator share. Google and Amazon built custom silicon. Revenue hit the designers first, so that's where investors looked. But here's what most people missed. A chip design has zero value until someone can actually manufacture it at scale. Think about what an AI accelerator goes through before it reaches a server. Hundreds of steps. Material gets deposited onto a silicon wafer. Microscopic patterns get etched in. The surface gets cleaned and measured. Then, the processor gets combined with memory, packaged, and tested. Every new generation makes this harder. Smaller transistors need tighter control. HBM adds more layers and more steps. Advanced packaging connects processors and memory with almost zero room for defects. That complexity is what turns AI demand into equipment orders. Once TSMC, Micron, Samsung, or SK Hynix commits to a new line, it begins ordering equipment well before production starts. After installation, toolmakers earn more revenue from service, spare parts, and process upgrades. A factory expansion can support them for years. Here's the edge equipment makers have that chip designers don't. They sell into GPUs, custom accelerators, memory, and advanced packaging all at once. They still ride the semiconductor cycle, but they don't need one single chip architecture to win. Their advantage comes from selling across many customers and architectures. A Google TPU, an Amazon Trainium chip, and an NVIDIA GPU follow different designs, but their manufacturers still need deposition, etch, and inspection tools. Semi expects wafer fab equipment sales alone to hit $143.9 billion in 2026, up 23%, with foundry and logic spending reaching $78 billion. Memory is driving much of that acceleration, while leading-edge processors provide a second engine. That gives this equipment cycle a broader base than a recovery built on one chip category. Why HBM needs so many tools? If there's one force tying AI demand directly to equipment spending, it's HBM, high bandwidth memory. Here's the simplest way to think about it. Large AI models move so much data that memory speed can actually bottleneck an expensive GPU. A processor sitting there waiting for data is wasted computing power. HBM fixes that by stacking memory chips vertically right next to the processor, connected by microscopic wires that run straight through the silicon. Picture turning a single-story warehouse into a skyscraper with high-speed elevators on every floor. But building it is a nightmare. Manufacturers have to create those connections, thin the wafers, stack the dies, bond them, and inspect every layer. One defective layer can wreck the entire stack. And here's the part investors keep missing. HBM eats up more wafer capacity than regular DRAM for the same output. So as memory companies shift more production toward HBM, they need extra capacity just to keep up with everything else. That creates two demand streams at once: specialized tools for HBM itself, plus more conventional capacity to replace what HBM displaced. TrendForce expects HBM to hit about 22% of total DRAM wafer input by the end of 2026, up from 18% at the end of 2025, and climbing to 30% in 2027. Micron expects its HBM business to grow from roughly $35 billion in 2025 to about $100 billion by 2028. It's already locked in price and volume agreements for all of its 2026 supply. Semi forecasts DRAM equipment sales hitting $38.8 billion in 2026, up 39%, with NAND equipment climbing almost 31% to $13.9 billion. A separate semi forecast puts total memory equipment spending at $52 billion for 300mm fabs. Different measurements, same signal. A sharp recovery is underway. From data centers to factories, the spending starts with the cloud companies. S&P Global Ratings estimates Alphabet, Amazon, Meta, Microsoft, and Oracle could spend more than $700 billion combined in 2026 capex, most of it flowing into data centers, servers, and networking. Only part of that reaches chipmakers directly, but the scale is still enough to justify factories that cost billions and take years to build. Micron plans to invest more than $250 billion in U.S. manufacturing through 2035, targeting 40% of its DRAM output domestically. It just added up to $3 billion for its supply chain, including $500 million toward a new global wafers facility in Texas. SK Hynix is putting $3.87 billion into an advanced HBM packaging and research facility in Indiana, targeting production in late 2028. Here's the nuance that matters. This is a packaging facility, not a front-end DRAM fab. More memory dies don't help anyone unless you can package them with processors at high yield. This build-out spreads demand across front-end fabrication, packaging, and inspection. And that's exactly where our three companies come in. Applied Materials, the broadest toolkit. Applied Materials has the widest exposure of the three. Its systems cover deposition, materials engineering, inspection, and packaging, giving it a piece of both advanced logic and memory spending. Its latest quarterly revenue hit $7.91 billion, up 11% year over year, with non-GAAP earnings per share up 20% to $2.86. Management guided next quarter to $8.95 billion, plus or minus $500 million, and now expects its equipment business to grow more than 30% this year. Here's the trade-off. Breadth means Applied is less sensitive to any single boom. If HBM spending explodes faster than the rest of the market, Lam might have more upside torque. What Applied gives you instead is balance, plus recurring service and spare parts revenue from its massive installed base. Its real risk isn't the industry, it's expectations. Investors already expect strong growth. A good backdrop won't save the stock if results come in even slightly short. Lam Research, the memory cycle amplifier. Lam Research gives investors more direct exposure to memory capital spending. It specializes in etch and deposition, the exact steps that get harder every time a chip adds layers. Its strength in DRAM and NAND gives it direct leverage to HBM. Lam's March quarter revenue hit $5.84 billion, up 9% from the prior quarter and 24% year over year, with gross margin at 49.9% non-GAAP and operating margin at 35%. Next quarter is guided to $6.6 billion, give or take $400 million, with gross margin guided even higher to 50.5%. Management also just raised its full-year wafer fab equipment outlook to $140 billion industry-wide. Here's why this matters. Lam produces the strongest upside when memory makers raise budgets together, HBM and conventional memory reinforcing each other at the same time. But that sensitivity cuts both ways. Memory companies slash equipment budgets fast when prices weaken, and Lam often feels that pain before it ever shows up in a chipmaker's earnings. Buying Lam is a concentrated bet that HBM stays tight, conventional memory keeps recovering, and manufacturers keep funding both. KM getting paid to find defects. KLA plays a completely different role. It doesn't process materials at all. It hunts for defects and measures tiny features before those flaws destroy an entire batch. In an HBM stack, one weak bond can ruin several good components packed into the same unit. Catching it early saves enormous money, and even a small yield improvement carries huge value in leading-edge chips. KLA posted $3.415 billion in revenue, up about 11% year over year, beating the midpoint of its own guidance. Next quarter is guided to $3.575 billion, plus or minus $200 million, with non-GAAP gross margin guidance centered near 61.75%, reflecting exactly how much customers are willing to pay for process control. KLA wins from both new capacity and rising complexity inside factories that already exist. Every new process generation creates more points to measure and more software and services to sell. But that quality comes at a price. Literally, its premium valuation raises the cost of disappointment. A great business can still be a bad investment at the wrong price. Picks and shovels still have a cycle? Calling these companies the picks and shovels of AI can create a false sense of safety. Don't fall for it. All three sold off hard with the rest of the semiconductor sector in July. Here's the first risk. Chipmakers order equipment before factories even start production. If customers overestimate demand, the industry builds too much capacity, memory prices weaken, and orders slow fast. HBM itself could follow that exact pattern. Micron, SK, Hynix, and Samsung are all expanding at once, and AI server demand has to absorb every bit of that new capacity. Any slowdown creates a real risk of oversupply. Export controls add another layer of uncertainty, since a meaningful chunk of these companies' revenue comes from Asia, including China. New restrictions can block shipments or scramble order timing overnight. And valuation might be the most immediate risk of all. These stocks entered 2026 with sky-high expectations and ran up hard in the first half. A perfectly healthy business can still see its stock fall if earnings estimates simply stop climbing. 3 different bets. These 3 stocks express 3 different views of the same buildout. Applied Materials is the widest bet. For investors who think logic, memory, and packaging all grow together and want less dependence on any single category. Lam Research is the leveraged bet. More upside if HBM and conventional memory both accelerate, more downside if memory makers pull back. KLA is the quality bet, a moat that gets paid more as manufacturing gets harder, at a premium price that leaves less room for error. Watch HBM investment from Samsung, SK, Hynix, and Micron over the next few earnings seasons. Compare hyperscaler CapEx against what these equipment companies actually guide to. And watch advanced packaging specifically, because continued investment in HBM, chiplets, and CoWoS expands the entire market these suppliers can sell into. The manufacturing thesis is taking shape. The market just hasn't confirmed it yet. July's pullback hit the toolmakers too, proof that investors are still reassessing the whole sector, not neatly rotating into it. The machines behind the boom. The AI buildout has entered a far more expensive stage. Building a wafer fab, an HBM line, or an advanced packaging facility takes years, and those projects can support equipment and service revenue across multiple product cycles. Semi expects record equipment sales, memory companies are expanding HBM, new U.S. factory and packaging projects keep moving forward. Applied Materials, Lam Research, and KLA can all win across different chip architectures. Their earnings will still swing with customer budgets, export policy, and the broader cycle, but none of them need one specific winner to succeed. The first phase of this AI rally was about pricing scarce computing power. The next phase might be about pricing the machines required to build it. Applied Materials gives you breadth. Lam gives you memory cycle upside. KLA gives you process control quality. The best pick depends entirely on which of these companies can outrun the expectations already baked into its stock price. So tell me straight in the comments, which one would you rather own at today's valuation and why? Subscribe to TradingKey for more market analysis. I'm Phoebe. See you in the next video.